4 stocks to buy in June 2017. So each month I'm going to try and look at 3 to 10 stocks that I think are attractively priced right now, and then share those stocks with you. So the first stock that I think is attractively priced right now is Lyondellbasell Industries. They are a maker of plastics and chemicals, as well as they have a smaller oil refining business. So here's the stock chart for Lyondellbasell, or LYB is the symbol for them. So as you can see, they've really kind of been stagnant since around late 2015, and then just bounced around in this area in here. So right now they are on kind of a downward trend, which means that I think the price is attractive. If you look at places where they have bottomed in the past after a downward trend, it looks like it's bottomed at around $70 a share here, here, and then kind of around here. So I think that would be the absolute farthest that this stock would fall, unless something major happens. But right now they're really attractively valued. I'll get into the fundamentals more in a minute. But I think then short-term support would just be right here around 77. That's where they bottomed after the fall right here. So that's just the stock chart for them. So now I will move on to their Morningstar page and give you some info on that. So they have a forward price to earnings of around 8.3. I'm not really sure why that's not showing up here, but that's what it is. And then if you go down here, their current price to earnings is a 9.2 versus their industry average of a 23.3 on there in the chemical industry, which is in the materials sector. And then they have a price to book of 5.1, which is kind of high for a value pick, and that's what I'm thinking this is, a value pick, but it's still lower than their industry. And then their one issue recently has been their revenue has fallen slightly, and so has their income growth, but I still think that they are attractive because at this low valuation and they have a dividend yield of 4.2%, they're pretty much going to be, I don't think they can fall very much further, I guess, because the price to earnings is so low and they're paying a high dividend, and they have a good margin too. So even if prices on some of their supplies goes up, they still have wiggle room in their margins, and then they have low debt. I mean, I guess not low, but not super high. So that's not a problem with them. So I'll just move on to the Fidelity page now, which has information on their past earnings all the way back to Q2 of 2015. So this again highlights that their earnings are kind of stagnant for this time period. But if you look at what the analysts are projecting for Q2, they're projecting $2.74, which is definitely a lot higher than it has been recently. And from here, you can see the analysts, this is what they're projecting, and then this is what the earnings actually were. So the analysts have been pretty successful in predicting earnings for this company. So I think it's pretty safe to say it's going to be around $2.74 per share next quarter, which, like I said, that brings them to a forward price to earnings of only 8.1, which is ridiculously cheap if you look at the valuation of that compared to the S&P 500 or their industry, which was shown here as a 23.3. And so now I'm just going to dive into their most recent earnings report. So you can see that these are their olefins and polyfins. I guess, sorry, I don't know exactly how to pronounce that, but that's pretty much their plastic products. And so here's the most recent quarter. They generated most of their income from that. But they also have more money here, and then also a smaller refining business, which if you look at their EBITDA, the refining business definitely has been kind of slower than the rest of their business, but I still think that that can pick up, and I think that even without the refining business, they are doing well with their plastics and chemicals. And so with this low valuation and a decent growth potential in their refining business, I really think that they are going to perform well in the long term and in the short term. So the second company that I think looks attractive in June is Shire Plc, stock symbol SHPG. And they are a pharmaceutical company that makes quite a few products. They make Adderall, which is a treatment for ADHD, and they have several other ADHD products. And they have lots of products, and I think hemophilia and a few others. And they just make treatments for rare diseases, so that's kind of their main thing. So here's the Morningstar page for Shire Pharmaceuticals. So you can see, the forward price to earnings is 10.4. They have a price to book of 1.9. And they do have a dividend yield of 0.48. It's very small, especially compared to the last stock, Lyondellbasell, which had a 4.2% yield. But this company isn't really a yield play. I think that they have really strong growth potential and are trading at a pretty strong value. So this price to earnings is not, I wouldn't look at it because I think they haven't updated it from the last quarter earnings report. So I think their current price to earnings is a 99. But then after their next quarter earnings comes in, that will bring them down to a 10 to 12. But as you can see, the price to book is 1.9. And on a pharmaceutical company, that's very strong. They have a good price to sales as well, and low debt, which is always nice to see. But yeah, I'll move on to their Fidelity page now. So this is pretty much just compares the price of the stock to their earnings. So as you can see, they've had very strong earnings growth in recent quarters, pretty much just in the high $3 per share per quarter range. And they've been beating the analysts' expectations in all of the most recent quarters. So as you can see, for the next quarter, they're projected $3.53 per share. So I think they'll probably be around there, if not beat it. And like I said, that will bring their price to earnings to around 10, which 10 to 12 is very cheap for a pharmaceutical company, especially one that has a strong pipeline and strong growth potential in the future. So looking at their pipeline here, you can see they have 5 studies in phase 1, 9 in phase 2, and then 18 in phase 3, which is really good. And then they just have registration for 2 going on, and then 5 that have been recently approved. So I bought this stock, I think, 4 or 5 days ago, and the day after I bought it, they went up 4.5% because they reported successful results on a phase 3 clinical trial for I think it was a disease called, the abbreviation was HAE, and it's a rare disease. I think they said between 1 in 10,000 and 1 in 50,000 people have it. But pretty much it's a disease that made people who have it, their extremities swell up very severely. And they had a trial with a placebo and then with their drug. And pretty much the people who were taking their drug had 87% less episodes where their extremities swelled up. So that's really, really impressive. And once they get approval for that, that could be another strong selling drug for them alongside their current drugs and then all of the other phase 3 studies that they have going on. So here is the chart for Shire Pharmaceuticals. So as you can see, they are down from highs that they reached back in 2014 and 2015. And they've just kind of been trading down in the range around here. And recently they just jumped up from, it was about $168 a share to their current price of $189 a share. But I still think that it's a very attractive buy. Like I said, I bought in, I think it was $185 per share. But I'm still thinking it's a good purchase because, like I said, strong valuation and strong growth potential in this stock. So the third stock that I think looks attractive right now is Delta Airlines. I'm pretty sure everyone knows Delta Airlines, but they're pretty much the largest airline, and I think that they are a really attractive stock right now. All right, so here's the Morningstar page for Delta Airlines. So as you can see, they have a forward price to earnings of 8.3, dividend yield of 1.7%, and then a price to sales of 0.9. So here, their current price to earnings is an 8.9, which is very attractive, especially compared to the S&P 500, but then also compared to their industry. They have a 2.7 price to book, which is nice to see as well. I mean, it's not super low, but it's lower than their industry. And then as you can see, they have a solid margins, especially compared to their industry, a full 2% above the industry margin, which it's nice to see a company that has good margins, because then they're not going to be as damaged by fluctuations in prices, especially with an airline stock. That would be fluctuations in oil prices, because that is pretty much one of the main expenses for an airline is fuel. So they, if oil goes up in price, that could hurt their margins slightly, but since they have a high margin right now, that shouldn't be too big of a problem. And then, so what's really impressive about Delta as well is their low debt. As you can see, 0.6% compared to an industry average of 1.3%. I think American Airlines has like a 6.6 debt to equity, which is really, really high. I'll actually just quickly check on that, but just to compare them to one of their main competitors. So yeah, American Airlines, 6.6 debt to equity, which is really, really high. So Delta definitely looks more attractive on that front. So here's the Fidelity page for Delta. So as you can see, here I'll show the share price. All right. So they had higher earnings around here, and then it's down the last few quarters, but still in line with what analysts have been projecting. And they've been meeting or beating the expectations on earnings. And then it's projected that their earnings are going to go right back up to where they were. I'm not sure why they were down the last few quarters. Maybe some one-time expenses during that. But if you look, it's their earnings are projected to go right back up to where they were in the future, and they still have a very low price to earnings ratio right now. So here's the chart for Delta. They were up a lot from lows back in mid-2016, and I'm not a huge fan personally of buying companies that have gone on a nice run recently, but they have pulled back, and I still think that their valuation is very attractive where it is at right now. So even though they are up from their 2016 areas by quite a bit, I still think that they have an attractive valuation. The fourth and final stock that I'm looking at right now is ExxonMobil. They're the largest oil company, and they're an integrated oil company, so they have discovery, they're taking it out of the ground, they're refining it, and they're selling it at gas stations, and I think, and they also sell chemicals and other things along those lines, but they're mostly focused on oil. And I think they're an attractive. So here is the Morningstar page for ExxonMobil. They have a forward price to earnings of 17.5 and a 3.7% dividend yield. So ExxonMobil it's a massive company. It's the largest one in the oil industry, and it's one of the larger companies in the S&P 500. So I think that they are currently the most attractive oil company. They've shown an ability to generate profits, even during a very, very tough time for the oil industry. As you can see, last quarter they had 95 cents per share earnings. And even through 2016, when oil prices were really, really down, they were generating earnings. And they have projected earnings that are the same for next quarter and then slightly higher in 2017. I'll go back to their Morningstar page. So they have a very, very low debt, and they have a strong balance sheet. I think they have the strongest balance sheet of any of the oil players. So that's good to see, especially in a time where oil stocks are down a lot, and the oil industry is struggling. It could be a time where some consolidation goes on. So Exxon could potentially purchase another oil company. I mean, that's just speculation, but oftentimes in industries where there's struggling companies, some of the stronger companies will purchase some of the companies that are struggling at low prices. So as you can see, lots of assets, very, very low debt right now, just overall a very solid balance sheet, and they've shown that they can generate a profit even during a tough time for the oil industry. So here is the chart for Exxon. These, unlike the other charts, these candles on this chart represent 1 week of trading. So this goes all the way back to 2013 over here. So as you can see, they're down significantly from highs of 104 back in 2014. They're up slightly from the bottom of 71 where they were. And after that, they rebounded up to 95. And now they're down at $83 per share. And they've really just been kind of trading flat down there. But it looks like they might be starting to form a little bit of a bottom down there at $83 or $81 to $83 per share, and could be headed back up. I know they just recently announced that they're going to start opening some gas stations in Mexico, which could be an interesting play for them. I know that will be another way for them to generate more revenue. So hopefully that works out for them. If it does, I think that will definitely be beneficial to them. So I think overall they're a good company, and they're at an attractive price right now. So that's the final stock for this video. That since this is already going to be over 20 minutes, there's 3 other stocks that I think are attractive right now. So I'm going to be making another video on those 3 probably pretty soon in the next few days when I get some time. So thank you for watching. I know this is my first video. So if you enjoyed it, please like and subscribe, and I would really appreciate that.